more into the start of U.S. trading. Let's get a check on the markets here as we see things rebounding from last week as President Trump backs off of his threat to place 50% tariffs on the EU on June 1st. That's been pushed back, at least for now, to July 9th. We also are just getting the Conference Board's consumer confidence reading for May coming in here higher than estimated at 98, actually much better than the 87.1 that was estimated here. Present situations index at 135.9. Expectations not as strong as 72.8. But, we keep talking about the gap between the soft and the hard data, and that the soft data has been deteriorating more. Here's one example where we are not seeing that come in as weak as had been expected, and that also that May figure was a rebound from the April reading. So the major averages all trading higher by at least 1% right now. We want to take a look at the bond market as well. We have been seeing yields pull back a little bit. We see the 30-year yield in particular back below 5%. There's some rumors about an action over in Japan on the part of their central bank to slow down Treasury issuance. That appears to be having a bit of a ripple effect around the globe on yields as well. And then finally taking a look at Bitcoin this morning, which, as we know, last week went about to 112,000, now back below 110,000 this morning. Well, we had that breaking consumer confidence data crossing the wire coming in at 98. Economists were expecting 87.1, an increase from last month's reading of 86. I want to bring in my co-host for the hour, Julie Hyman, ProShares global investment strategist. No relation, as we always say. Simeon and I have been doing stuff together for many years. And we have Eric Winograd, AllianceBernstein chief economist. Both of you guys, thanks so much for being here. Simeon's going to be here for the hour. Eric here to talk to us a little bit about some of the data we've been getting. So let's start with that consumer confidence reading, because it is interesting to see, and unusual lately, to see a survey that comes in stronger than estimated.
Yeah, it's nice to see a little bit of a rebound. We've seen significant weakness in a lot of the survey data, in the soft data, as you point to. And, it suggests that consumers are at least somewhat sensitive to the news flow, the back and forth on tariffs. We got the back, if you will, and now with the forth, consumers seem to be feeling a little bit better about things.
And do you think that that is going to translate? There was concern on the downside of the survey data that it would translate into lower spending. But do you think there was actually going to be any significant change in spending, or do we just go back to status quo at this point?
So, look, the correlation between the hard and the soft data is imperfect, right? It's not perfect. It's never been perfect. It's probably less perfect now than it would normally be. I think we also want to take a step back and look at this in perspective. Consumer confidence indicators are still lower than they were a few months ago. They're, again, back and forth, but generally trending lower. This is also only one measure of consumer confidence, and some of the others look a little bit weaker. So we do think still that the soft data are sending a leading signal about where the hard data are going to go over the next few months. We do expect a slowdown in consumer spending.
Eric, what if we get back down to this 10% thing that's supposedly the floor? Is that enough to have a material impact long term? Let's assume all the other crazy stuff doesn't happen, but the 10% sticks.
Oh, I think that's enough to have an impact. It's an interesting perspective to put on it. If I had told you coming into the year that we were going to have a 10 percentage point increase in the universal tariff plus some additional stuff on China, I think most people would have thought of that as a very bad outcome. It's only because we have seen worse that all of a sudden doesn't look so bad. Is that enough to crater the economy, to push us into a recession? Probably not. But it is enough to have a meaningful impact on both growth and on inflation.
And so what is that impact? If 10% is the baseline, if that is where we end up, how should we be thinking about that?
So that probably pushes prices up by about 1% for the economy as a whole. If you otherwise would have had inflation at 2.5%, you probably now get it more like 3.5% or something like that. In our estimation, that's enough to slow growth down by give or take 0.75 percentage point. We have been assuming over the course of this year that the effective tariff rate increase will be about 15 percentage points, which is, call it a 10% universal plus 25% or 30% on China. That raises prices by 1.5%, and it slows growth down in our forecasts to about 0.5% for the year.
So if that's the case, when can we look to the Fed to when can the Fed be sure enough that's going to be the outcome, that it can actually move?
So the Fed has been clear here that they're going to rely on the hard data, not the soft data, and particularly the labor market data. Remember that their mandate is the labor market, not growth in general. It won't be until we see true weakness in the labor market that I think the Fed will be comfortable moving. Minneapolis Fed President Kashkari this morning was only the latest Fed president to signal that they're going to wait and see how things play out. I think that that's the message they will all deliver until we get 1 or 2 week payrolls reports, and then they'll be ready to cut, in my estimation.
If you look at consensus forecasts, you got 2 cuts this year, 2 cuts next. So you got 3.5 or so on Fed funds, but only 4% on the 10-year. To me, that seems a little flat. What do you guys think in your shop?
So we're concerned about the 10-year and the 30-year in particular as it pertains to the fiscal position, and that makes it much more difficult to forecast them. Normally you would look at the business cycle, you would have an expectation for Fed policy, and that would guide you to your 10-year forecast. But with fiscal policy in play, with the one big beautiful bill under discussion, there's no evidence of fiscal restraint, and if anything, we're seeing additional fiscal deterioration. And as a result, we expect the yield curve to steepen. We think that longer dated yields are going to be sticky, that it's going to be hard for them to come down the way they normally would during a rate cutting cycle.
And so how do you think about the economic impact if indeed we're going to see that 30-year yield higher?
The long bond yield and the 10-year yield matter a lot more than the Fed funds rate to the real economy. There are a lot more prices that are indexed to those longer yields, mortgage rates being only the best example. And so it makes it more difficult, in a sense, for the Fed to ease policy if you have interest rates not respond further out the curve. Simeon, you mentioned what's priced into the market now. When I look at what I think of as mispriced, it's the cuts next year, right? The idea that the Fed is somehow going to deal with an economy that is slowing and not cut beyond neutral, right? That they're still going to have a policy rate that's in restrictive territory, and that's going to be enough to stabilize the economy even while long yields don't come down. I'm skeptical of that. So in our forecasts, we have more easing next year. We have a total of 6 or 7 rate cuts as opposed to the 3 or 4 that the market is pricing over the next 18 months or so.
And then, but if that's the case, is the Fed sort of combating the effect of rates staying sticky? And then if they cut further, are there risks to that?
Absolutely. Look, there are risks, and one of the risks is if the Fed is cutting while fiscal policy is easy, you have them both pulling on the same end of the rope, and you do start to worry about long-dated inflation expectations. You worry about whether the market will assume fiscal irresponsibility and monetary policy accommodation, especially as we move into the period where Chair Powell's term expires and where President Trump will be able to appoint a new Fed chair. If there is concern that the Fed is cutting not because they need to, but because the political side is telling them to, the whole situation looks very, very different.
The downgrade, de-dollarization, is that in the mix of how you guys are looking at the yield curve?
It is, absolutely. I don't care very much about the downgrade, right, in the sense that we've seen the U.S. downgraded before, and honestly, if the U.S. is not AAA or whatever, it doesn't make any difference in terms of the way that investors behave toward it. Treasuries are still perceived as the risk-free asset off of which other assets are priced. If that changes as a result of de-dollarization, things again start to look very different. It's a classic finance dilemma in the sense that the probability of de-dollarization is very low, but the consequence of it would be very high. And it's not at all clear how investors are supposed to protect themselves or to position for that. But yeah, absolutely, that's in the firmament, and it's a topic that we're going to hear a lot more about, particularly as we work through this budget negotiation.
Well, okay, so let's talk about the budget negotiations to leave off our chat here. On balance, is that bill good or bad economically? I know good and bad are very broad terms,
yes.
But how are you assessing it from an economic perspective?
So from an economic perspective, what we would say is the following. It is likely to expand the deficit. We are already running the largest budget deficit we have ever run outside of a war or a recession. There's nothing in that bill that suggests any sort of fiscal restraint. If anything, it is likely to expand the deficit. I think most people would agree that at a time when the economy has been performing well, you would like to see fiscal consolidation. You would like to see the deficit going the other way, but we don't. There are things that from a business perspective will be welcome in the form of tax cuts and so on. Those are being used, however, to offset the offset to those is the spending cuts that are in the bill are being used to offset tax cuts rather than to consolidate the budget position. I think most budget analysts would prefer to see some sort of consolidation, but with Congress completely unwilling to consider tax increases or revenue increases, you're left in a position where it is very difficult to see fiscal discipline. And to be honest, the only force that is likely to force that to happen is the bond market. We've talked and you've heard about bond vigilantes resurfacing. I don't think they really have yet, but unless and until they do, I don't think the political side in either party is likely to do what is necessary to reduce the deficit.
Well, that certainly has been true thus far.
Yeah.
And there's no signs that that's changing. Eric, thank you so much for coming in. Appreciate it.
Thanks
As we said, Simeon's going to stick around. And coming up, we take a look at some trending tickers on the Yahoo Finance platform. We'll bring you the news behind the moves next on Catalysts.
What usually happens to Nvidia shares after earnings? Our number of the day, 3.9%. That is how much Nvidia historically gains the week after earnings. 3 months later, it's up an impressive 17.5%, and 1 year later, Nvidia is up nearly 120% on the median, which makes the case for buy and hold in this very volatile stock. Investors, they will often look to history for clues as to future direction. So, will Nvidia surge again, or will new market dynamics rewrite history this quarter?
Now time for some of today's trending tickers. We are watching CoreWeave, Rocket Pharmaceuticals, and SoundHound. First up, CoreWeave getting its first downgrade since filing for its IPO in March. Barclays downgrading the stock to equal weight from overweight, calling short-term upside limited, but also raised its price target on CoreWeave to $100, saying the analysts there remain optimistic long-term. Despite all of that, CoreWeave shares are currently higher by 15%. Wow, what is going on there? We do see a little bit of an AI trade more broadly, of course, but interesting to see the stock moving up by that amount, that continued momentum. Remember, the company came public at $40 for its IPO, so trading already well above those levels at the moment. Shares of Rocket Pharmaceuticals sharply lower after the FDA paused a trial of its gene therapy treatment for Danon disease after a patient died during the study. Rocket said it voluntarily stopped patient dosing in the trial after one patient experienced symptoms of capillary leak syndrome. Rocket says it's working to restart the study, but does not have an estimate of when that will happen. You know, in a company like this, an experimental biotech that doesn't really have a product on the market, when you get news like this, it is obviously detrimental to the shares. So you see that big drop that we were watching. And finally, Piper Sandler initiating coverage of artificial intelligence audio company SoundHound AI. Analysts rate the stock overweight with a price target of $12. Shares of SoundHound AI moving higher this morning after the note, which called the company a direct AI play and estimated it could serve a $30 billion market by 2027. SoundHound shares have been relatively volatile as we have watched them, but today with that big gain, SoundHound a little memey, I think we could say fairly, but the stock reached a record high back in late December of 24.23. So obviously it has halved, more than halved since those levels. So has indeed seen that level of volatility. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, coming up, we dive into the effect Nvidia's earnings could have on the market rebound. That's on the other side of this break.
This is Yahoo Finance. I'm executive editor Brian Sozzi and also the host of the Opening Bid podcast. One of your favorite companies from the Magnificent Seven, of course that's Nvidia, reports earnings this week. And how the numbers shake out could dictate the next big move in the AI trade. Wall Street analysts are predicting another positive quarter of earnings growth fueled by demand for all things AI. But while Wall Street's feeling bullish, environmentalists have their concerns. And here's why. Nvidia is the world's most powerful chip maker with a market cap of more than $3 trillion. But behind Nvidia's record revenues and profits is an overlooked cost, the environmental impact of chips powering the big AI boom. Nvidia holds about 80% of the AI chip market. Their GPUs, or graphics processing units, power things like ChatGPT, autonomous vehicles, and of course, video game graphics. The company designs the chips, then outsources manufacturing to foundries, also called fabs. The bulk of AI chip making happens in East Asia, and that's where energy use is absolutely surging. Fabs are energy intensive, and they're mostly powered by fossil fuels. For example, in Taiwan, over 80% of electricity still comes from coal, oil, and gas. Electricity used from AI chip making jumped more than 350% between 2023 and 2024, according to a recent report from Greenpeace East Asia. In Taiwan alone, the industry now consumes as much electricity as 93,000 Taiwanese households, says Greenpeace. Global electricity demand for AI chip making is estimated to reach nearly 40,000 gigawatt hours by 2030. That's more than the current total of Ireland's electricity consumption. And by 2027, AI electricity needs could be comparable to the current total of Argentina's electricity consumption, according to a recent study by the New York Times. Google, also a Mag 7 member along with Nvidia, has said it will likely miss its climate targets due to increasing power demands of training AI models. The world's AI future is being built chip by chip, but as the industry scales, so does its environmental footprint. Keep that in mind as you read Nvidia's financial statements and earnings call later this week. With those profits, there is a cost.
Nvidia is reportedly planning to launch a new AI chip for China at a lower price than the H20 model as it looks to navigate U.S. export curbs. This comes after the Trump administration restricted the shipment of Nvidia's H20 chips to China without a license. That happened in April, leading to an expected $5.5 billion quarterly charge from the company. The company's market share for AI chips in China has plummeted from 95% before export restrictions took effect in 2022 to 50% currently. That's of the AI chip market specifically, and that's according to CEO Jensen Huang. Still, China does remain a huge market for Nvidia, accounting for an estimated 13% of its sales in its fiscal year 2025. Earlier this month, Huang said that China's artificial intelligence market will likely reach about $50 billion in the next 2 to 3 years, and that missing out on it would be a, quote, tremendous loss. Well, as for Nvidia shares, they are on the rise ahead of its results. They're due out after the bell on Wednesday, and it looks to be lifting other Magnificent Seven names with it ahead of earnings. So what does all of this mean for the AI trade and for the market more broadly? Joining us now, Phil Palumbo, Palumbo Wealth Management CEO and CIO, who oversees more than $500 million in assets under management, among them Nvidia. Phil, thanks for being with us. So, obviously we're watching the shares very closely, the company very closely, but we're also looking at the ripple effect here. So talk to us about sort of the importance for Nvidia for the rest of the market.
Yeah, so Nvidia is the backbone of this AI movement that we're seeing, which I believe are in a second and third inning. And there's more than just the AI. Then there's robotics, the autonomous driving, which is all tied to chip development. And Nvidia has a leg up relative to their competitors, closest being AMD. So in my personal view, it's, short term, there could be volatility around all this, but longer term, Nvidia is the biggest player then, and that's not going to cease as we think about that space going forward.
Hey, Phil, Simeon Hyman, how are you? As I've been looking at the AI sector for the last couple of years, and it's almost the upside down of the late 90s, where the benefits have been going to incumbent players rather than new disruptors. But we've been talking a little bit this morning about some of those disruptors starting to get some traction. Does that make it better for everybody, or does it challenge some of the dominance of the incumbents?
I feel that it's an area right now where there are going to be a lot of players, especially the pure plays that are privates like Cerebras, which eventually go public. They're going to be a big player in this particular space. So I think there's just a lot of room for other people to also thrive. It's not just Nvidia, but Nvidia for sure is the dominant player, and I just don't see that stopping right now.
Phil, if Nvidia, what we've seen recently is even if it reports strong numbers, the shares sometimes go down because the expectations are quite high. What then does that do to the Magnificent Seven trade? Is it lasting? Is that an opportunity on the flip side for people to maybe add to their positions? What do you think?
It's not all tied together. I mean, everybody within the Mag 7 does something different, right? Like Microsoft right now is dominating in the cloud business. Nvidia is dominating in the chip business. I mean, it's all relative to AI, but they all do something different. So it doesn't mean if Nvidia is going to get crushed that they're all going to get crushed in tandem. So, but I just don't think that's going to happen. I do believe that I think Nvidia is going to have a very strong print, and I think that it'll be an engine behind the other Mag 7s. I do think you'll see some of that, but I do think at this point it's going to be on an individual company basis.
Sorry, go ahead. Go ahead, Simeon.
The quality of the broad market, the S&P 500, we have return on assets, other quality metrics almost double than they were 20 years ago, driven in part and in large part by those magnificent seven. Is there anywhere else we can see some of that earnings and return on capital power coming from?
I don't for now, because the growth behind this economy is going to be in AI and continue to be for some time. A lot of the investment today which is over $300 billion, and that's only going to grow going forward. So AI is definitely going to be a big part of that. In the utility space, that's a particular space. We need energy to drive these data centers. So we're seeing growth in the utility space, and I think that will continue going forward. So it's all kind of tied together in some way. Look at copper, on the commodity side, is starting to rally. Why is that rallying? Because electricity and copper is needed for that. So we're seeing different markets that are going to grow as a result of this AI demand.
So Phil, when you're talking about portfolio construction, how, everybody's talking about the sort of AI thesis these days. So how heavily do you sort of weight in that direction? How diversified should people be? What role should that be playing in people's investments?
So I'm a big believer in, quote unquote, the Warren Buffett Munger style of investing, where you own a core group of really great businesses. Berkshire Hathaway is one of them. Costco is another one. Waste Management, Johnson & Johnson as a couple of examples. And then, you have we call elite tech, right? So elite tech, those that are dominating in an area that's really growing today. And that's what you want to be involved with. You mentioned before the late 1990s. I would argue that when you think about these businesses and think about the free cash flow generation, it's much different than the late 90s and those internet companies. We're talking about companies that have real strong growth. You have incredible free cash flow. I mean, Microsoft's at 70 billion. Nvidia's at like 80, 90 plus billion. Margins are at 40% on Microsoft, greater on Nvidia. And their multiples are not nearly as high as they were back in the late 90s. So when you're thinking about building a portfolio, you want to have your core positions. You want to have your elite tech, which for me is the Microsoft, Nvidia, Netflix, and Tesla. And then I do believe you want to have your emerging technology, companies that are going to emerge like the next Nvidias of the world and the next Amazons at some point in the next 5 or 10 years. And then we wrap that around using privates, so because in the private market, there are, like I said before, pure plays that will perform really, really well over the next 5 and 10 years. So you want to make sure you're involved in a private market as well, which is really an area that's growing tremendously.
Phil Palumbo, thanks so much for being here. Appreciate it.
Thank you.
And of course, still with me is Simeon Hyman. Simeon, I want to talk a little bit about a theme that we were talking about earlier in the show, because I think it's something that you're anxious to talk about, or that you're excited to talk about. And that's what we're seeing in the bond market and sort of the bigger theme of deficit concerns, the effect it's having on yields, et cetera. We were talking with Eric Winograd at the top of the show about this. And you both agree that we are potentially looking at a steepening yield curve. Now, a lot of people hear the word steepening yield curve and their eyes might glaze over, especially people who are primarily equity market investors. Why do you think it's happening, and why is it important economically and for other assets?
We can make a list of a dozen reasons why the yield curve may be steepening, and you only have to believe in just a couple of them for it to likely happen. As an example, you could dismiss everything except a little stickiness in inflation, and you'd find yourself to, say, a 5% 10-year easily, because the long-term real yield on the 10-year Treasury is about 2.5% above inflation. We're at 2.5 now, that makes 5. And if just a little bit of tariffs takes us to 5%, then you could have north of 5% on the 10-year. So it's tough to argue against it in the absence of a real recession. The implications, they're in a couple of dimensions. Certainly on the bond side, it tells you you should be careful about your long-term bond exposure. We have an ETF, IGHG, it just hedges the interest rate risk out of investment-grade treasuries. But it also can prompt you to think about getting yield and income from places that don't have anything to do with interest rates. And one part of that in the equity market that we've been focused on is infrastructure. But infrastructure in a very specific way. When people think of infrastructure, they often think about companies that build it, that pave roads, that build bridges. Here we're not talking about that. With our ETF TOLZ, the ticker is tolls. That's for a reason, because it's the toll takers, the companies that own it. And that's super inflation resistant stuff with a 3 and change yield on it. So those are the opportunities that I think are important. It tells you to be careful about long duration exposure in your bonds, but it tells you to focus on yields and growing yields in the equity market.
Something else I want to ask you about related to all of this is, I can't tell you how many strategists we've spoken to recently who say, well, everything else being equal, corporate profits are still okay. And so that gives them some solace in this tariff environment, et cetera. But then if we start to see yields go up even more, what effect does that have on profitability? You know, borrowing costs go up, you know, you see sort of cascading effect potentially. Is that something that we should be watching?
So let's talk about the good stuff first, and then talk about whether it's under attack, if you will. It's absolutely true, as Phil just told us, cash flow is cranking out of the S&P 500, particularly driven by the Mag 7. Return on assets and profit margins are double what they were 2 years ago. Also, very importantly, leverage in the S&P 500 is at all-time lows. So therefore, a little bit of a tick up in the cost of debt might not be that big a deal. But 100%, the risk is, can a little bit of a whiff of a little bit of extra inflation and a little bit of lower growth, even from just a little bit of tariffs, can nick those margins, and they have been the underlying fundamental drivers. So it makes some sense in our view to look a little bit beyond the Mag 7 for some companies that may have some sustainable ability to keep those margins. You know, we've talked for years about dividend growth stocks. Particularly, we think, don't overlook mid-caps. People worry about concentration in the Mag 7. Okay, well, maybe I'll equal weight the S&P or something like, well, why not just go to mid-caps? They're the number one slice of the equity markets for 4 decades in a row, and they're dividend growers there. Our ETF REGL, the S&P 400 Dividend Aristocrats. So those are some of the ideas that we have in terms of thinking about that rising rate environment.
And then we've gotten everybody's views on AI today, but we haven't had a chance to ask you your views, you know, ahead of Nvidia and that big push back into the Magnificent Seven and the broader AI trade. How are you thinking about it?
I do like this broadening of the AI trade to include some new disruptors, which we talked about this morning, because it has been, from my perspective, being kind of the old guy and remembering what happened in the 90s when it was disruptors. There was a book called The Innovator's Dilemma that said that when there is a new technology, incumbent companies can't take advantage of it because it destroys their existing cash cows and they don't know what to do. It's been very different this time around. The youngest companies at the top of the heap are companies that are 20 and 30 years old already. But I kind of like that there are a few disruptors showing up in the new issuance market, because I do think that gives a little bit of a broader flavor to the AI initiative. It is a revolution, and it's going to be an important part of the market.
Simeon, good stuff. And you're going to stick around for a bit longer. Coming up, the Senate is expected to make big changes to the House reconciliation bill. We'll dive into what that could mean for consumers and the economy. That's next on Catalysts. President Trump has said he wants to sign the GOP tax bill into law by July 4th. But the bill passed by a narrow 215-214 margin in the House and still needs to be voted through the Senate. Here to break down the path ahead for the bill and the Republicans' agenda and what it's going to do to the deficit is Douglas Holtz-Eakin, former director of the Congressional Budget Office and president of the American Action Forum. Doug, it's always good to see you here. So do you think that Senate Republicans who are more fiscally conservative will have any success here in getting some tweaks to the bill? And are those tweaks going to make much of a difference in the big picture?
Well, I don't know. I mean, we'll see how much of an appetite for change the Senate has. You know, the two big moving pieces are what's the appetite for spending cuts? And certainly the Senate budget resolution didn't show the same appetite as the fiscal conservatives in the House. I don't know if recent developments in the bond market may have changed that. That'll be worth watching. And in general, you know, how much can they take on in terms of cutting the spending programs? And then there's the question of the bill itself. from an economic point of view, there's a lot less at stake here than there was in 2017, which was a dramatic reform of business taxation and much simplification. This extends current law, which will do essentially nothing for the growth path of the economy, adds a bit in investment incentives, which are important but not dramatically large, and then just a whole host of things which are not simplification, which are no tax on tips, no tax on overtime, special carve-outs for seniors. There's not a lot at stake there. That's a short-run bump in the economy at best. So they may decide to get more serious and take a page out of 2017 and do more fundamental reforms. We shall see.
Hey, Doug, Simeon Hyman, if there's not that much at stake here, does that mean there's not enough here to offset, say, this most benign 10% tariff level if we get there? Is there just not enough to offset it?
Well, first, I hope we end up with just a 10% tariff and we can characterize it as benign. But we have a lot more than that on the table right now, and there's not near enough here to offset that. So I am concerned about the growth path of the economy. The biggest accomplishment of the legislation would be to avoid a sunset of the 17 law, which is a $400 billion tax increase next year. And we say, well, that's not particularly desirable, but we've already done that this year. And so certainly we don't need both.
And so, Doug, if we see sort of the base case of this bill passing in some form, even if it's just an extension of the tax cut, if indeed the base case is 10% universal tariffs, if that's where we end up, what does all of that put together mean economically?
I think not a lot, quite frankly. The U.S. has a trend growth rate somewhere in the 1.8 to 2% range. There's talk of some of this moving into 3%. I don't see anything in the tax plus tariff world that looks like a dramatic change in that trend growth rate. You need to have some genuine, powerful supply side incentives, like getting the corporate rate from 35 to 21. We don't have anything like that on the table right now, and so I don't expect big changes. There might be some short-run boost from a lot of cash in the hands of people who get no tax on tips and no tax on overtime, but that's a transitory thing and won't get you past 2026 probably at best.
So, Doug, I'm going back to the downgrade, and I know Moody's was the last of the three, but I take a look at AAA rated U.S. industrials. And AAA rated, which the U.S. is not anymore, have zero spread to treasuries at the 3-month tenor, but a 50 basis point spread to treasuries at the 10-year. So we know that time exacerbates credit risk. Are you worried at all about the downgrade or the de-dollarization, any of that? Does that come into your thought process?
Yes, I am worried about this. So, we got downgraded in 2011 by S&P Global, and they said, boy, the politics in the United States are really bad. And then in 23, Fitch said, the U.S. does not seem to have the political wherewithal to manage its finances effectively. Both of those were about the process. Moody's said, you have too much debt and too much interest. That's the problem. It's a very different downgrade, and one that I think is far more serious because it's not talking about the politics. It's saying whoever's there has got too much debt and they're going to have to carry too much interest. That's a real concern. And, we've seen no particular appetite for dealing with deficit fiscal position thus far in the Trump administration. And I certainly hope that tune changes. We really can't afford to just likely go down this trajectory much longer.
Doug, I'm sure I've heard you say that before, and a lot of folks have been saying that for years, right? So
yeah.
There's no appetite for this. That much is very clear in D.C. Some people are talking about it, but broadly, there's no appetite. The thing I keep coming back to is what would change that? What would force the hand? Would it have to be some kind of credit crisis on the part of the U.S., or are we just going to kind of muddle along until something breaks?
So, a favorite theory is it takes a crisis. And I certainly, have been asked a lot, when does the crisis hit? And the truth is, I don't know the answer and I don't want to run the experiment. I don't know how long we can do this. I want to tell you a short fairy tale about how it gets fixed, and it revolves around Social Security. It is the case that for years, Social Security has been the third rail. No one wants to touch it. But the trust fund is going to go bankrupt in 8 years, maybe less at the next trustees report. And that means that in the absence of action, retirees get a 21% across the board cut, which you and I both know is never going to happen. But that means there will be Social Security reform somewhere in the next 8 years. And that's a good thing. And if you're 55 right now and you want to retire at 65, you don't know what your benefit will be. And increasingly, people are going to understand that. And when they go to the town hall, it's not going to be, hey, don't touch Social Security. It's going to be, hey, what am I going to get? When are you guys going to settle this? How are you going to fix it? And that's a good thing. That's a debate we have to have. I think events are going to force it on us, not political courage, but we're going to have to come to terms with that. And once you start, pulling at the Social Security thread, you can't do this all on seniors. They're going to start looking everywhere in the budget. And so I expect a reemergence of genuine debate over policy issues in the budget over the next 5 or 6 years.
I'm always baffled. We're all living longer, we hope. Why doesn't anybody talk about the obvious solution of just pushing back the retirement age just 2 or 3 years? Wouldn't that massively help the problem?
It would have big impacts over long periods of time. But, if you let it get to the position we have, which is you have only a few years and you've got to get money in the trust fund, you're going to see, I think, the payroll tax cap raised, some measure which brings cash in the near term. And then you also have to accompany that with genuine fixes to the growth and benefits, because our arithmetic budget problem is not complicated. Social Security and Medicare are more than 1/2 of all non-interest spending over the next 10 years. They are the bulk of the budget, and they grow faster than everything else. Social Security grows at 5.5%, Medicare at 7 to 7.5%. And so unless we slow the growth of those spending programs, you can raise taxes, but they'll just outgrow the tax base even at the higher rates. And you can't just keep chasing it. You got to fix it. So fixing those programs becomes the key.
Doug, great to catch up with you as always. Thank you.
Good to see you.
Coming up, tariffs are already taking a toll on Chinese exports. We'll talk to a shipping executive about the outlook for the global industry next on Catalyst. The 90-day trade truce between the U.S. and China leading to an increase in weekly container bookings, more than doubling during the week of May 12th after the deal was announced. Joining me now, Semiramis Payou, Diana Shipping CEO. Now, Trump announced that delay on EU tariffs, and if those were to take effect when the deal expires in July, what impact would you expect, Semiramis, on global shipping?
Hello, and thank you for having me, first of all. Just to clarify, the shipping industry is a big industry, and there are subsectors within that. So we have the container sector, the oil and gas sector, the dry bulk sector, the car carrier sector. My speciality is mainly in the dry bulk sector. We own and manage 37 dry bulk ships. So I guess each sector will be affected by the trade, the tariffs imposed, depending on the amount of trade they have with the U.S. So, for example, the car carriers or the container sector will probably be more affected by any taxes imposed or tariffs imposed in the U.S., whereas the dry bulk sector its exposure to the U.S. is less exposed. So I think I believe the exposure will be limited.
Have you seen any effect, though, either with your business or just more broadly on dry bulk shipping? Because there have been some concerns that even with the pause in the most severe tariffs, that there are still disruptions to the system.
Yes, you are correct. Our main trade with the U.S. has to do with the agricultural goods. So there's a lot of export of grains from the U.S. into mainly China. We have noticed that there has been a pause of U.S. grains imported into China over the last few months. And that has diverted into other markets. So, for example, we've seen a lot of exports of grains from Brazil into China instead of the typical U.S. market. So obviously it has been affected.
Semiramis, it's Julie Hyman, and I think you sort of answered this question, but this isn't what I do every day, but I'm an old school strategist, so I look at the Baltic Dry Index and I observe that it's been sort of hanging in there, just a little bit below kind of a long-term average. Is that surprising you, or is it consistent with your sort of not the place you'd see the worst impact theory?
Well, the BFEX, as you call it, is accustomed to being volatile, and it's a representation of the general uncertainty we feel in the market. It has to do with the freight rates, it has to do with the economic views we have about the countries. It's not only about the tariffs, but of course the tariffs have added to this world uncertainty, economic uncertainty. Yes, so I guess you are right about it.
So for you, which tariffs are the most important for you to be watching at this point, right? Either geographically or sectorially, what is going to be the most important portion for your business?
Shipping has always been very adaptable, and there are always disruptions. So to be honest, it's not something that we monitor closely, as we believe it will not affect our industry per se. What I think is very important to understand is tariffs, or anything that causes the cost of transportation to increase, whether it is the fuel costs or whether it's any port use or anything that might increase the cost transportation. I think it's important to understand that it will be borne at the end of the day by the customer. I think that's a very important takeaway.
Yes, and I think it's one a lot of U.S. consumers are paying a lot of attention to ultimately. Semiramis, thank you so much. Appreciate it.
Thank you. Thank you.
And so with me is Simeon Hyman of ProShares. Simeon, we've talked around the tariff issue over the past hour. Is that 10% universally, is that your base case? Should that be investors' base case? Because I got Jamie Dimon on one shoulder saying we're underestimating the effect at this point. I'm sure there's lots of strategists on the other shoulder who are saying we're overestimating.
I don't know that I'd have a more educated view on handicapping this. What I would say, though, is if we do get to something like this 10% level, and maybe a little bit more on China and a couple sprinkles here and there, that's a level that should act more like a tax. In other words, it's unlikely to disrupt global supply chains, but it will have a little bit of an uptick pressure on inflation and a little bit of a downtick on growth in the U.S., but not totally disrupt supply chains at that level.
And is that counterbalanced by what we could get from Congress?
I don't know that it's enough. We were just having that chat, and it, again, because most of this tax bill is just continuing the previous regime of tax cuts, that might not be enough to offset a little bit of this whiff of, it's not quite stagflation, just a little bit more inflation, a little bit less growth.
All right, well, we'll see what ends up happening with all of it. Thank you so much for being
Thanks
here
for
with me
having
for
me.
the past hour. Appreciate it. A big thank you to my co-host for the hour, Simeon Hyman, ProShares Global Investment Strategist. Coming up is Wealth, dedicated to all your personal finance needs. Brad Smith has you for the next hour, so stay tuned.